Yeah, the old birth and times combo. Nice to see everybody. Happy Monday. Let's get started. Pretty wild week last week, and probably shaping up to be a pretty wild week this week. I'll show the screen here in just a moment. We'll start off with volatility. Let's talk about the tail of the tape and see where things were at from last week. Really quickly, risk disclaimer. We understand this risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose. Whether you're trading stocks, options, futures, forex, cryptocurrency pairs, whatever asset class you're trading, you know the risks. All right. If you're following me out there on social media, best place to find me is right here, YouTube channel, youtube.com/Chris Pulver. I also stream on Facebook and Twitter, Twitch, and LinkedIn. And you can find me out there, Real Chris Pulver, on Instagram and TikTok, which I post some videos and shorts, and I should be posting some additional content this week. All right, let's get into trading and the charts. Hey, everybody, happy Monday. Let's go. Daniel, nice to see you. Dennis in the house. Don is here. Andrew here. David, Fauna, nice to see everybody. Let's jump in. So I want to start off with the Volatility Index. We are sitting at 29.91. We've had a lot of spikes higher. We have yet to really crack the lows on the major indices, but things are certainly looking vulnerable. Last week during our Flex Room and also our session on Friday for the Pulver Report, we took a look at this tool right here. This is a CME Group Fed Watch tool, and this did a complete 180. Last week when we took a look, it was like 75% expected for a 25 basis points rate hike to a 25% 50 basis points rate hike. And you can see that that has recently switched. So right now, the markets are trying to figure out how they're going to price in a 50 basis points rate hike. We also have increased tensions, escalated tensions in Russia, Ukraine. We have oil prices that poked $95 last week. Lots of volatility continues. Complications with the Russia-Ukraine border, complications with Russia to Europe, Central Europe, right? So last week, Friday was a wild day. I was teaching classes and had some, real trading stuff that took me to the 3:59 p.m. Eastern time. I literally had credit spreads that were in the money that should have expired, and I should have been able to close like 3 or 4 trades up with a 0.01 debit. And those credit spreads were still very wide going into the actual market close. So I was monitoring everything this weekend. I did get assigned SVXY, which is a kind of a inverse volatility play. But I'm long volatility, and we have some straddles running still. I have a straddle running on Apple. We took some straddles on SPY and other stuff. But it's going to be a pretty wild week. There's going to be winners and losers. There's going to be some crazy movement. There's certainly a lot of volatility. We saw it happen also quickly in Forex. If you take a look last week on Friday, the Japanese yen, on rumors that Russia would, possibly invade Ukraine within a matter of days. It just seemed like the market just took this, the rumor, and ran with it on Friday. So this was what Friday's Forex day finished up to be, and you can see the Japanese yen just soaring. We also have the Swiss and the dollar getting a little bit stronger, but your risk-on pairs. What was interesting to see in the euro get so weak. But again, Europe, Eurozone, Central Europe, certainly affected by this increased tension going on. And again, we don't know if there's actually going to be a conflict. We don't know. And it sucks to be sitting here wondering. And look, at the end of the day, you have to trade, right? So if anything, this means probably trade smaller because volatility is going to be higher, and possibly trade smaller because volatility and direction might be indecisive. It's also important to have some cash at the ready to take advantage of good opportunities if things present themselves. But look, I'm kind of bracing for everything, right? There's a lot of stuff that can happen. We can see this continue. This is today's Forex currency strength. We saw Japanese yen just continuing on last night. So 3 a.m., 4 a.m. Eastern time, and then we just plunged back down to equilibrium here on the Japanese yen. So things are kind of starting off a little bit, screwy for an early week. We have a lot of trading ahead. Obviously, we're just getting started. But we're going to see what happens through the U.S. Open this morning. Do we start to see some currency pairs trickle back up to the highs and get stronger today? As far as the tail of the tape last week, Dow Jones was down 1%. S&P down 1.82%. NASDAQ down 2.18%. So everything U.S. index-wise in red last week. Bitcoin actually did cling to a positive week at 1.13%, but it gave back most of it. In fact, if we look at a chart for Bitcoin really quickly, you will see that last week's candle is mostly a rejection, right? Look at that. Bitcoin all the way up towards 46,000 plus and closes all the way back down. So somehow, I think this was according to Friday's close, it clung to a slightly positive gain for the week, but massive rejection candle right there. And we're going to see what this is made of. So again, 42,600. I'm sure that, tens of millions of people crashed the Coinbase website last night during the Super Bowl. Happy for the Rams. It was a weird game. It was a no penalty contest the entire game, and then 3 flags thrown in the last 2 minutes inside the red zone. Look, I mean, I was cheering for Stafford and the Rams. I think Aaron Donald deserves it, Stafford as well, and it was just a weird way to end the game. But you got to feel for the Bengals. I don't know, but they're young. Joe Burrows will figure it out. But good game overall, entertaining halftime show, all that good stuff. So hope you enjoyed the Super Bowl, and now it's back to the real stuff like trading. All right, so we'll see where Bitcoin goes this week. Take a look at the dollar or the daily chart. We are pulling back towards the monthly pivot level, and there's some pocketing around 40K. So if we have a decent bounce, I mean, look at this technically. I'm looking at a decent bounce here around 40,000, and if we see this little pocket filled, offering some support, we have a nice little rally, pull back into this pocket, find some demand, take this up for a higher high. Let's start targeting 50,000 plus. Let's start getting back to this pivot cluster here at 60,000. Now, with the ongoing risk-off tone that the market is apparently showing us, I don't necessarily see this being the play. So I wouldn't be surprised if we test 40,000 and we don't bounce immediately, then we might just be coming all the way back down to revisit lows, possibly revisiting 30K. And that is a really important floor. For right now in the technicals, 30,000 in Bitcoin is super important. If that does break, if we break below 30,000, it's going to make some hodlers nervous, I would say. There's some decent structure that suggests that 30,000 shouldn't hold. We also have this little channel we've talked about the last couple of weeks. Connect the highs right here. Connect the lows right here. And if we break that area, I mean, that gets us down towards 30,000, and this is very vulnerable to the downside. Okay? So, again, keep your eye on the prize. I've not added anything more to Bitcoin since we had my levels here, the 45, the 40, the 35 I've added there. Ethereum, it was 3,000 and 2,500. Those are my big dollar cost average levels. I'm waiting. We saw a big retreat on pretty much every crypto last week. All right. What I'm watching this week, in all honesty, is the Volatility Index. We've had a lot of increase. I mean, this is over the last couple of months, increased in volatility. We're obviously not towards, the 2020 crash levels. We're certainly not towards the 2008 crash levels. But we have heightened volatility. You can see that we're making higher lows. That's pretty easy to see. Now, I'm wondering if the Volatility Index starts to spike up into these areas, finds the 2021 yearly pivot, and we'd see the VIX maybe spike up into the 40s or 50s. If that's the case, I'm still holding some VIXY longs. And pre-market we're up about 4 cents. I do have a take profit here, and this is possibly very conservative. We have, a lot of chaos, but it's also about 100% gain from my current VIXY position. So if we run up to $40 and we find this past support, I'm going to look at either taking some profit there around $40 and change, or certainly putting in a trailing stop loss like right away, maybe a 5 to 10% trailing stop loss. I know that this is also a volatile instrument, but again, this is kind of my way to take some stabs and maybe hedge with what's going on and trying to be a little bit more bulletproof. Another thing we have to keep an eye out on is the TNX, the 10-year note. For the first time since 2019, cracked above 2%. It did retreat a little bit. We're at 1.975. If you have been following me for the last 3 months, 6 months, 12 months, we've had this pretty much on our chart since late last year. If we get into this 2 to 2.5% area, this can pretty safely be, well, I mean, last year we didn't really have all of the discussion on just inflation. So this does make things a little bit more difficult to see, okay, would fixed income exit the markets and exit equities because the borrowing rates are up? Well, not necessarily. Not when you have inflation in the U.S. at 7+% and your fixed income. I can park it in a 10-year Treasury for 2%, 2.5%. and I'm still going to lose 3.5 to 4% to inflation. So no, fixed income isn't just going to drop out. Cash is crap. Bonds are dead. So I mean, it's forcing investors to just try to not lose money by keeping some type of preservation of capital, principal stability, while also just not expose themselves to tons of volatility that the market is clearly trying to throw at us right now. So all that being said, there's a lot to navigate, all right? And we know that. But the good thing is trading with a community certainly helps, and keeping objective analysis and trying to stick to the charts and stick to the technicals, be fundamentally aware, but be technically obedient. That's going to be important. If you're taking some notes on where we're at for the year thus far, NASDAQ is actually down, S&P is down, Dow is down. Respectively, 11.85% in the NASDAQ. Again, tech is toxic right now. Obviously, things are on sale. Things are crazy discounted. We have some earnings this week that I'm interested in. I've taken some nibbles on Coinbase, Netflix, OKTA, Twitter, Snap. Those actually, some have worked out pretty well. Snap was actually a fantastic trade. I didn't even have to own the stock. And in the Equities on Demand trading room, we grabbed about $7.43 of credit out of that trade, which was fantastic. And no assignment, which was even better. S&P down 7.29%. Dow was down 4.4%. The 10 years up, like I said, hit the highs from 2019. We have not been up to 2% since that time. Currently, it's up 42 basis points for the year. And Bitcoin's down 8.6% for the year. Oil is up 25% for the year. So pretty wild and crazy. Earnings this week for stocks and options traders. We've got some notables. Avis Budget Group. Rental cars are, 35 to 40% overpriced. And does that mean that like Hertz and Avis and other car companies are making more money? Maybe, maybe not. I certainly don't want to rent a car ever because I think it's obnoxious. Saying that because I work from home and have for the last 10 plus years. I have an airport 2 miles away. I used to go probably once a week, a couple times a month easily, and grab a car for $20, $25 when I need it. And as soon as that price went up to $100 for a one-day rental, I just stopped renting cars. Like, that's not that hard to be like, I don't need a car that badly. Unless it's, an expense or something absolutely necessary. But that is an obnoxious rate for a car. And it's just funny how everything's like, oh, COVID. Oh, supply chain. It's like, well, there's only so much patience consumers have to be like, yeah, sure, we'll just take it on the chin and just pay more money for everything. So at some point, consumers are like, yeah, I'll just stop spending money and see how that plays out. So anyway, Avis Budget Group has earnings this week. Airbnb, Marriott, Hyatt. You're looking at some travel lines, hotels, obviously. We'll see if the travel sector is coming back. I'm certainly interested to see where airlines are going. I know that Delta Airlines has been doing okay. We've had a nice little surge off these lows, mid 30s all the way back up to the 40s. If you look at American Airlines, AAL, another decent run to the upside. Lows in the $15, $16 area. We're back down. Well, we're up a little bit. We're up as high as almost $19 last week, and we got pushed back down towards that risk-off flow on Friday. What else do we have? So I said Airbnb. We have Marriott, Roblox, for all those kitty coders out there and Minecraft lovers. NVIDIA, supply chain, or the semiconductors, right? Cisco, that's computer software, not the food company. Shopify for e-commerce. Kraft Heinz, consumer staples, more defensive, less volatility. Hilton, another one for the hotel. Dropbox, Planet Fitness. Fiverr, feature that actually a website I use quite frequently for some editing and some other cool stuff. I mean, they do a ton of stuff. It's just little gig. It's like little gigs. $5, $10, $20. It's gotten more expensive recently. The last couple of years, and more people started to use it. But you can find some amazing work for a very affordable price. I like that website a lot. Fiverr.com. John Deere and DraftKings. Obviously DraftKings is probably wishing that their earnings was going to reflect what happened last night in the Super Bowl, because we had like $7.6 billion bet, which was almost an 80% increase last year, or from last year. So thanks, legalized gambling. By the way, if you have a gambling problem, then call your local hotline, right? Anyway, but that's what's coming up this week with some notables. I will probably not be doing a ton of new trades this week. Last week on Friday in Equities on Demand, we looked up our 2/18 expirations. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 stocks with expirations this week. That's a lot. It's going to be an interesting week because obviously if I'm looking at some assignments, That's going to be something where I may want to be doing some crazy calculations on how much cash do I need to allocate for some of these. Is it worth managing and repairing some of these trades? Because the fact of the matter is, this week in equities on demand, maybe it's not. Maybe some of these trades are not worth keeping. Maybe it's better off just to lose on the stupid credit spread, keep the cash at the ready, and we can always get back in at better prices. But for some that we do like, we will start talking repairs. I'm still in energy stocks, which did extremely well last week. In fact, we didn't have any assignment. SU is Suncor Energy. We had to see if it stayed above $30, and it did. It closed above $30, and we did not have assignment. We actually took, if I'm not mistaken, we collected, let me check. I think we collected a few cents on our long put, and then we did not have the stock assigned. So let me double check on Suncor right here. Yeah, so we did cash in the long put, and then we still didn't get assigned because price was up above our strike price. So what turned out to be initially credit spread of 27 cents turned into a 37-cent win with no assignment. So that was actually a good result. The other one was CTRA. This one stayed well above our strike price. It stayed above 22 bucks, so that was full credit. The reason I had these written down is because going into the last couple of minutes on Friday's trading, these trades were still not closed at a 0.01 debit. And usually when we take credit spreads, going in towards expiration the day of, you could close these things easy for a 1, 2, 3 cent debit, no problem, and take 95 to 97% of the profit you had from that initial credit spread. But spreads were so wide on Friday with this increased tension, increased risk-off trading that I couldn't get anything close. So I just removed I canceled the orders, let them expire, and fortunately things worked out where I didn't take any assignment. SLB was the other one. It finished above 40 bucks, and this is another one that we avoided assignments at $40.62. Pre-market's down a little bit, but it was above 40. That's all we needed. So good stuff on those three. I did get assigned SVXY, and my break even on this one. So pre-market is $52.99. Pre-market SVXY. I do have some ownership, and I own it at $53.45. Realistically, this week I did notice that it tied up a lot of cash and margin on that assignment. So if we hit like $55 to $56 this week, I'm probably just going to take it off the table and be done with it, make a couple bucks on the trade and just turn and flip it. We can always revisit SVXY later on, but I'm going to set a couple of chart alarms here. I've got one set at 56. I'll set one at 55. I'm okay just grabbing some profit at 55, give or take a few bucks. Okay. All right, so that covers a lot stock-wise. Like I said, it's going to be a busy week with equities on demand and currencies. We will see if things start to get more exciting today. I was watching last night, and we had chart alarms going off Sunday night during the game. Also this morning, Japanese yen strong, Swiss and dollar, your risk-off flows. The euro was still in the baseline, but Aussie started to make a little comeback. The Japanese yen dropped hard, and the New Zealand dollar is still slightly softer. So we'll see if this starts to break open once again through later U.S. trading as the London session comes to a close. Forex-wise this week, let's go into the calendar. I know last week was a big one. Headlines mainly CPI on Thursday for the U.S. Let's go this week, high impact. What do we have? So this week, oil inventories, Fed speaker, BOC speaker, CPI for the U.S. That's last week. Never mind. Here we go. Let's start with some CPI. So we have pound CPI, CAD CPI, retail sales for the U.S. We have FOMC meeting minutes, so we might again see like all eyes on the Fed, knowing that the market is essentially pricing in a 50 basis points hike in March. If the Fed is going to either one, there was rumor last week they're going to have some secret meeting and possibly raise rates before the March rate, do like a 25 basis points hike before the March meeting, see if the market surprises. But the Fed's not really a surprising type central bank. They tend to drift this stuff to the market early on. They've been a permanent backstop for the last decade. So for them to be like, yeah, we're just going to do stuff without anybody knowing it, I doubt that's going to happen. So we'll keep an eye on the meeting minutes on Wednesday afternoon. Aussie employment news. We have manufacturing numbers, G20 meetings. We have Fed speakers once again, retail sales for CAD, existing home sales, G20 for a couple of days on Thursday, Friday. All right, so CPI is the big one. UK CPI, CAD CPI, and we had US CPI print last week. So, look, we know this. Inflation's running hot. It's pretty obvious. Right? Let's see here. Let's get some comments. Let's see. Travel coin. Okay, rumors going up. U.S. truckers starting a convoy now. Ugh. Fine. I mean, I don't know. This weekend, has anyone read Ray Dalio's book? His Principles book, and then The Changing New World Order? It's like, yeah, it's a lengthy book. It's 400 to 500 pages. You can also catch him on, he does a bunch of like podcasts and interviews and stuff, and he talks about his book, and he always references it. But, I mean, we're in just a really odd cycle in the world. Again, I'm not using this like some PSA, but it's like, I get it. I mean, there's a lot of distrust in the system. There's a lot of, anxiety. There's a lot of anger. But man, it's like, this stuff is really disruptive. And I suppose as a trader, it's very disruptive. It's like, look, volatility is good, but we don't need volatility paired with crazy amounts of uncertainty where the markets can just swing however they want and be crazy irrational. Like, that's hard to trade. That's hard to predict, right? Because things go farther and faster than you expect, and all of a sudden technicals kind of break for a little bit. So that does make things a little bit more frustrating as a trader. But again, it's what I signed up for, so that's what we got to do. But anyway, all right, let's get some other comments here. Catherine, so I was assigned SoFi at 1450. Okay, yep, same for me. We did cash in on SoFi on the long put, did we not? We cashed in. So credit spread. Oh, fudge, I'm going to have to check. Did we close out updated SoFi? Yes, okay. So closed out SoFi, there we go. We closed out the long put for 85 cents. And my break even right now on SoFi, because of all the credits that we've had on SoFi, I mean, we've drilled this cost down. We've had a lot of credits. I only have a couple hundred shares. Now I have 400 shares. So I'm going to update this for today. Shares, that was the 11th. 200 shares, assignment was 1450, and that is now going to be assigned. So those were assigned. My break even is now 1297. There's my updated credit. So if I'm taking anything else, I know that I'm running with 400 shares, break even 1255. Hang on a smidge. So 999, 1297. Oh, there it is. So there's my update. So I actually owned it at 1255 because of that long put. Got it. All right. So, and honestly, SoFi I like. I mean, sitting at these levels, I mean, it's at major support. I would like to see RKT. I'd like to say SoFi could do really, really well. I know that SoFi has earnings coming up that we are playing. We have another credit spread out to March. I believe SoFi's earnings are March 1st, and we have a credit spread out to the 4th. So we're going to continue to play this. And with the shares that we have and a decent break-even price, I mean, I'm still looking to hold SoFi into, 19 to 20 bucks before I let it go. So I'd like to turn this into a, 750 plus per share win, and we'll see what we get. All right, so that is open. But yes, I was assigning that as well. Okay, what else do we have? Euro dollar currently short for the week. Price might be looking for a double bottom. Yeah, we'll see. Look, before we go into a bunch of pairs, let's start out with the big picture. So dollar index, what are we doing? Has the dollar index structure changed? Not really. So even with all the craziness last week, what do we have? Dollar index still has a chart alarm high, chart alarm low, nothing is broken. Not yet. Now, I could see more indecision as the Fed has minutes this week. Is it enough to maybe break it higher? Maybe. Maybe not. So is it the dollar gets a little bit strong, Fed minutes come out on Wednesday, and somehow there's like a dovish tilt to the FOMC minutes? I don't know. I don't know. Obviously, I don't know. If I did, then we would obviously plan a trade. But there's still a lot of indecision that we are planning around, and I still think the path of least resistance on the dollar in general is stronger. I think we're going to go higher on the dollar index. It's just when is the market going to actually officially break these levels, right? So are we going to come back down to retest this low first, retest this possible, past resistance, yearly pivot, channel support, and then we start going up? Maybe. Maybe that's how this plays out, right? Or it simply just breaks the highs, keeps going, gets stretched, gets overbought, gets ridiculous, leaves all these breadcrumbs and inefficiencies, and then the Fed puts in a top, and we end up shorting the dollar back down later. That's what I think makes sense to me. So, I mean, if I'm looking at, where the heck am I going to short the dollar like crazy? It's when the dollar index is up here. So that being said, on the euro dollar, I mean, sure, I can see the euro dollar dropping back down, but if the dollar index is still indecisive, the euro dollar is going to be the same way. We have a lot of indecision, especially off that ECB push. What started out was a little bit of this, correction, is now just way noisier. So we have equal highs around 14, it's around 1,500 now. That was the high from the post ECB. But we have this level that is a little bit of a fake out to the downside. So the dollar index is going to influence the dollar or the euro dollar. I still think there's room down to 1.10, possibly down into 1.08 before we really start to look and see, okay, where would a bottom form in the euro dollar? Those are the strong levels, in my opinion, for the dollar to form, or the euro dollar to form some lows. If we form lows sooner than later, and it forms now, and this is still, some type of structural pattern where the dollar gets softer, and this does make its way back up into this past support, yearly pivot, pocket, harmonic levels, all these things we've been talking about technically, obviously I'm not going to complain about fulfilling those levels, then shorting the euro dollar later. Okay? But what is kind of frustrating is noticing that the correlation of dollar index to euro dollar to dollar Swiss is not quite the same, right? You're getting a lot of volatility on the euro dollar. You're getting next to nothing on the dollar Swiss. Reason why is you've got strong Swiss and strong dollar, or you have weak Swiss and weak dollar. So this is trading a lot more like the dollar yen, okay? Where it's not a breakout. We pretty clearly see 9,100 support and 9,350 resistance. Now I still am bullish on this currency pair overall. I'm still looking to accumulate off of these lows. If they're offered, I'm buying support. I'm still going to take it up to this level. My plan would change if we came back down to 8,800. I would stop looking at 96 as much, but I would look at equal highs around 9,450. But I still think that could be a double bottom, that if you measure that and go twice that move, that still gets us back up towards parity in the bigger picture. So, again, it's going to take a lot for me to change my analysis on dollar Swiss, but I'm bullish on it right now. So if I'm bullish on dollar Swiss and that correlation sticks, euro dollar is probably heading lower, right? You can see my numbers here. These are all, pending orders that we have built. You're either buying lower on dips or you're adding on breakouts, still targeting 96.50. Okay? All right, dollar Swiss, you good on that Tron? Euro dollar, you good, Daniel? Break even 13.55. I had to sell some shares earlier. Okay, got it, Catherine. That's fine. That is fine. And we took some profit on SoFi last year as well. When it popped up to 18, 19, 20 bucks, I think that one popped up to like 24, I think. Was it? I know Fisker was up there. So these were highs around, $24 on SoFi. Took some profit on that one. Fisker was another one that I took some profit on last week. I had a put that was supposed to expire on Friday. I went ahead and took I think 60 cents out of the $1.60 that I could have made. Now, when I say could have made it, meaning I had to take assignment, lower my cost, I would have owned Fisker for $10 and change. I don't mind getting into this later, but to tie up margin on an EV stock that had a nice little pump, possibly a lot of the good times have been priced in. I don't mind revisiting Fisker, but we also saw this one go to sleep for a while, and then over literally the last year, it woke up. This is July 2020 or June 2020. So for the last, less than 2 years, we've had this stock be very volatile. I just think there's better ways to park my money right now. I'm still in energy. I'm still in financials. I'm still in staples. I'm still trying to kind of, as Ray Dalio puts it, all weather portfolio, where I want to have some diversification. Where if oil is going to go to $100+, we're in stocks that benefit from that. If volatility is going to go up and go crazy, we're going to benefit from that. If we have tech make a recovery, we're going to benefit from that. So we're trying to get a little bit of everything where we can still have some income generated in addition to managing some good stocks that we want to own. Okay. All right. SU cracked $30. That's on the retreat. It is 9:30. Wall Street's officially open, and looks like we are down slightly. So I'm going to set those chart alarms again. SVXY chart alarms, watching to see what we have. Friday was a very volatile sell-off day, as was Thursday afternoon. So if we take a look, let's zoom in really quickly on the SPY. Just because if you look at what happened Thursday afternoon to Friday, it was a pretty wacky turnaround. Right here, Thursday afternoon was this massive rejection, and then Thursday afternoon into Friday, we just came back and did what? This giant rally to the upside was just pretty much wiped out. So there still continues to be a lot of volatility where the market is reluctant to go higher, but at the same time thinking okay, maybe the Fed's got her back. Maybe there's still that backstop. Maybe they're going to be dovish again. And the market's also not pricing in new lows. Although I don't think it's that ridiculous to think that this high to this low high, low, lower high, lower low, I don't think that's impossible to see at all. I don't think that 400 on the SPY is that hard at all. I did see that Goldman Sachs lowered their S&P forecast. Their target is now 4,900 for the year, which I find interesting because I don't know, like, are they saying 4,900 is their target for the year, which would be less than 5% gains on the year for the S&P 500, but are we going to get there from some type of high, low, lower high, lower low? Let's say we have like a 15 to 20% correction, and then we have this miraculous rally just to get back up to these highs. Okay, so all I'm saying is I wouldn't be surprised to see more downside. If we have more downside, it makes sense. It would just be, even if it's a corrective move, I want to see if we max out this correction, high, low, lower high, lower low. We start to push that 15 to 20% correction. 4,000 would be a big round number on the S&P 500, 400 on the SPY. And if we get into 20%, we start getting into that correction / bear market territory. That puts us into about 3,800. But what's going to be interesting, if that is our sell-off point, if that's our big correction, and the market somehow finds the ability to say, okay, we've had a good correction, it's time to start buying everything on sale, and the market somehow finishes back at the highs or finishes even higher. I don't know how that's going to happen necessarily, but if it does, I want to see what that rally looks like. Because if it's down 20%, I believe we have to rally 30+% to get back to those highs. So to get back to break even, we'd have to have a 26% rally. To finish at the 4,900 target that Goldman Sachs is talking about, we'd have to have a 30% rally. So that's actually that's the video that I plan on posting this week. I'm working on it, but I want to just talk about the size of losses, the size of drawdowns, and what it takes to get it back. Because some of these tech stocks that are down 50, 60, 70%, Peloton down 80+%, it is like 800% gains to get back to the highs, 900% gains to get back to the highs. So my expectation is not to get back to the highs. My expectation is to get back to profit. One example that I will be showing is ARK. I'm in ARKK, right? I've taken some levels. I've lowered my cost quite a bit on ARKK. My break even's around $83. Now, for me to get back and say I'm going to take this one all the way to 160 again, I'm going to have to sit and wait for ARK to return 100% to get back to this level. Okay, and then some. We're at $70. We have to go 100% to the upside just to get back towards these highs. That expectation is ridiculous. In the near term, give it 3 to 5 years, maybe we do. But for right now, if we just make a return and find, past support, maybe it's that rally. Maybe it's that 15, 20, 25% correction where we can make some money because we've timed this a little bit better. So anyway, I'll talk about that this week in a YouTube video. Let's see. Shez says short the SPY. So here's the deal. Do I want to be short the indices? Not right now. I was short, okay, and we made some good profits on the Qs and the SPY. Here's what I don't want to do. If you short it, you got to be willing to take the loss. All right. I would say that here's where I want to short it. Realistically, if somehow we have the market rally back up to these highs and get everyone all excited, I'll short that. I think if we can short at these highs again, I'll short the highs. But to guess in here, this is, you could be long and short, and something's going to win because it is just as easy. This is literally a coin flip area. We go back up and we play between these levels because the market doesn't know which way to go without the Fed. What's the Fed going to do? Are they going to be dovish enough that we can start pumping money back into this, or we need to deleverage and de-escalate and start going into safe haven type stuff? So I just think the market doesn't know what it wants to do, and the Fed unfortunately has such a stranglehold on what it can do that it's just choking out sentiment. So we need to figure out what the Fed really wants to do. Obviously, the Fed's trying to go for a soft landing, but there's a lot of crap they're juggling. It's not just inflation. It's not just rates. It's not just borrowing costs. It's not just the official cash rate. It's also, geopolitically. Are we going to have a conflict in Central Europe? Are we going to have an energy crisis? There's stuff that's out of the Fed's hands, and again, they kind of caused it. And for the last 13, 14 years, it's like we've been building towards this friggin' bubble. And if people don't realize that, then I guess you haven't been paying attention. So do I want to short the SPY now? No, I don't. We shorted the SPY at a great spot. We took some profit. If we got back to the highs, I'd short it again. If we got back to the highs on the Dow, I'd short that. If we got back to the highs in the Qs, I'd short that. You know, I think that the best this market can do right now is high, low, equal high, equal low, equal high, equal low. That's probably the best case scenario right now for volatility. It doesn't really break any structure. We know our levels that we can trade within, but it's going to be topsy-turvy, right? You're going to see lots of changes in direction. It's going to feel like everything's great from the low to the high swing and everything sucks from the high to the low swing. But it's not really breaking and going lower, but it's certainly not breaking and going higher. Okay? So to answer Chez's question, no, I'm not short the SPY. I was short. We were short up here. You know, we shorted this thing at like the 474 and 475, and that worked out great. We shorted the Qs at the 308 and 310. That worked out great. You know? Or not the 40, what was it? The 4 and 405, I shorted the Qs. So anyway, take your battles, right? Pick your battles. Okay, let's talk some other currency pairs. Any stocks you want to know? I mean, like I said, I got a list of 21 that have expirations this week, so it's going to be a management type week this week in equities on demand. Forex-wise, I'm looking for some trading opportunities. I'll be watching the currency strength chart. Is it risk on? Is it risk off? That's what I'm going to have to assess this week. Oil prices, of course. Oil, gold, silver. Oil's up to 92 and change. I know that it's overbought. Okay? I know it's overbought. I know it's overstretched. Doesn't mean that it has to go down right now. Okay? We can continue to stretch until perhaps there's more clarity out of all this mess in Russia right now. Russia, Ukraine. Until that is more like, okay, the odds, the probability of a conflict are less and less and less. Or something, you know, comes up where there's negotiations. I don't know. Right? I'm speculating. I'm a trader. I'm not a freaking diplomat. But I will say that oil prices are probably going to continue to grind higher. Energy stocks are probably going to continue to grind higher. To what point? I mean, I think a correction is due, but I'm not interested in shorting oil right now. I'm really not. So I would be patient on looking to short oil. In fact, I would just stay long energy. I think that's a good sector to be in right now. Everything in energy could benefit from higher oil prices, and you know, the market is certainly behaving like oil is going to get to $100, you know, and even if it's struggling right now, it's like it might still just stretch to $100 and maybe higher. So I am really not going to turn bearish on oil until we revisit this 100 to 110 level that gets us back into those 2014 highs, right? All these highs back here, this is 110, 111. That's back into 2011, 2012 when we had some peak oil prices. But we are well on our way to get those again. Okay, so oil is going to continue to run pretty hot, in my opinion. Gold and silver. All this talk of risk-off trading, all this talk of, you know, hedging, all this talk of anti-inflation. So is gold up? Yeah, gold's doing fine. So for the last month, I mean, gold from 1800 to 1860, it's up a few percent, right? Gold's up like 2-3%. Yeah, there's up 3% gold. I mean, it's up. I've been bullish on gold since the break here at 1750 and kind of permanently long gold. What's interesting is if gold continues to stretch higher, what does the dollar look like? Because if gold stretches higher, usually the dollar gets softer, you know? So that'll be interesting to see, like, is this a risk off play? Is this an anti-inflation, anti-dollar play? I think gold comes back to test these levels. Okay? But is it just a runaway bull train on gold? Not necessarily. We are starting to break what I think is some pretty clear resistance right in here. If we have a good week, let's say that gold closes solidly bullish this week above 1880. I think that gold is on its way towards 1920. I think we've already measured this from this little flash crash low down here. We've already measured a head and shoulders to max that move around 1975. And of course, look left in the chart, see if we have a runaway move up towards 2080. But I am bullish on gold. Okay, is silver getting the same type of love in the market? Here's silver. Silver's at 23.84. I like silver a lot. This is another one that could be kind of an angled head and shoulders, like so. Deep left shoulder, head to neckline, right shoulder. If we break this neckline, this means we have to get above this yearly pivot about $25. If silver gets above $25, I think we're heading higher. Okay. All right. Pfizer's down a little bit. I'm going to have to get some covered calls in on Pfizer this week. Pinterest as well. SoFi. SoFi I'll probably leave uncovered, but Pinterest I'm going to try to repair, and SoFi try to repair as well if I can. Pfizer is down 49.71. I do have some staggered credit spreads on Pfizer, but I'm going to look at using those long puts out for the next few weeks. We have that discussion in Equities on Demand. So I'm going to try to get Pfizer's cost, pushed down as low as possible. But overall, I'm still pretty bullish on the stock. We have a nice little gap down here, a pocket level around like 47 to 46 bucks. I can see that level being found, and then looking to buy some more. Okay. All right, good stuff. So oil, gold, silver were good. Cryptos were good. We'll see what happens this week. It's kind of a toss-up week on Bitcoin. Do we pull back to 40,000? Do we pull back any deeper than that, or is 40,000 going to offer a bounce? This week, let's think about this. I'm talking about all these potential bad things in the market. What would be a good thing? A good thing this week. I mean, let's have some good news, right? Like, okay, we're talking about bad. Potentially good news would be there's actually some discussion, some peaceful discussion, some progressive discussion with Russia, Ukraine, right? So if that de-escalates a little bit, that can certainly help the risk appetite. If there are... If the Fed minutes reveal that the Fed is going to be on pace to raise rates 50 basis points in March, but maybe scaling back their expectations of, okay, here's why we're raising 50 basis points in March. I guess it depends on how transparent they want to be. If the Fed is going to be fully transparent, which one could argue that's never the case, but if they're going to be very transparent and try to drift all this info to the market, just get it out there, let the market digest it, for better for worse, then we can at least figure out where the market wants to go. But there's a lot of gray area right now that we're kind of trading. Will Russia invade? Will the Fed raise rates? If so, how far, how fast? And that uncertainty keeps everyone guessing. And that being said, that's why we watch the fear gauge, right? That's why we watch the Volatility Index. So one that you might want to keep a look at or keep an eye out for is the VIXM. If you're getting a chance to buy this thing around 30 bucks, this tends to pay out pretty well for a couple bucks a share, like every time. So we have some really strong support here at $30. I mean, if you buy the VIXM at 30 bucks, it goes up to 33, 34 bucks, take profit. Works out pretty well. And again, even if that's a short-term play to make you 3 or 4 bucks a share, it works out pretty well. All right, but I will be watching volatility. I've got chart alarm set. That's probably what this week is going to be, in all honesty. You come back and join me on Friday. We're probably going to have a lot of discussion on how do we manage this week, right? I've got open positions in Forex. I have open positions and expirations in stocks and options. How do we manage this week? I mean, I'm going to try to manage the best of my ability. If I have the chance to close up trades this week, I probably will. If I have the chance to mitigate some of my risk of the 21 stocks and options I have in expirations this Friday, I probably will. If I have to take some losses this week on credit spreads, that's fine. A lot of the credits we have been able to pull in have been decent. One thing we're going to watch this week, and if anybody trades options out there, look and see how wide the spreads are. If you're looking for a trade today, if you're looking at stocks that have earnings this week, and you're looking at credit spreads or anything, if those spreads are wide, that is not a good thing, right? That means that the available credit, the available liquidity is starting to get a little bit dicier. So I'm watching that, monitoring that very closely, because that certainly can have an impact on our ability to trade. Okay? All right, sounds good. All right, everybody. If you have any questions, let me know. Like right now, a couple minutes to wrap things up. If you would kindly hit that thumbs up button for me, that helps a lot for everyone watching. If you're watching live and we have 80 to 100 people watching live, and I get 80 to 100 likes and thumbs up, that helps this algorithm a ton to support the channel. And then look for a video to drop this week. If you subscribe, of course, that's awesome. And I'll continue to deliver good content. If everyone did take a look and see that I reorganized the entire channel, just trying to make those playlists super easy to find. So Trading 101, trending topics, live sessions, past recordings, nothing's hidden, nothing's stashed. It's all available, so you can watch whatever you want, and I'll just keep building out content. If you have any requests, any video you like, any comment you want to leave me, I'll add it to my list of topics to do, and I'll put them in the hopper and just keep chipping away and knocking out these videos every week. Okay. Daniel says, ever trade options on Forex? No, not really. Mainly because I've been trading Forex for so long that I don't know. I mean, there's not really an inherent bias in Forex like there is in stocks. So I really think that if you're trading options in stocks, it's a little bit better when like the edge is essentially, as long as you're bullish, you're typically batting like 55%. That's just like historically speaking. So I haven't traded options on Forex, no. I have a lot of traders that, ask me about trading CFDs, and if you're a non-US trader, you have some amazing instruments to trade like CFDs, which I don't have the luxury of trading, but I make do. Stocks, options, Forex, I just trade the currencies, build my positions, take my profits, and let some robots run. Okay. All right. So here's what's going to happen this week, everybody. Flex Room Tuesday, Wednesday, Thursday. Equities on demand Monday through Friday. Come back and join me for the Pulver Report on Friday at 9 o'clock. It's going to be a management week. All right. I wish I had like, hey, this is my favorite outlook. This is what I want to trade. I've got a lot of stuff running. I think that it's one of those weeks where I don't need to take unnecessary risks. Maybe I can be pleasantly surprised by the upside. Okay. But I also want to be managing the downside. I think it's important to know that if I have cash at the ready, I need to use it. If I have cash at the ready, I need to preserve it. If I have positions that are not looking so good, I need to cut them off. So there might be some trades where I just deal with, taking some losses in credit spreads, and that's fine, and then come back stronger for a better price. Maybe stagger out some expirations. We do have earnings this week to kind of wrap up a wild earnings. And I say wild because we've had, Amazon had great earnings. Facebook had terrible earnings. Google had great earnings, but we shorted Google at the high and made a ton of money. So, we've had wacky, high volatility gaps all over the place in all different sectors. And the one tried and true, it's like, I'm doing really well in the financials right now in stocks. I'm doing really well in energy. Those have been the two sectors that have been killing it right now. In fact, really quickly, let's go to that sector tracker right here and just see overall year-to-date what the markets have been doing. Let's go year-to-date for the sectors. Not even close, right? Energy is just absolutely crushing it right now. Financials is solid. Everything else in the slight red. But, would I have red with less volatility? Totally. So if I'm in utilities, they're not performing great as a sector, but it's down way less than everything else. So energy is, almost obnoxiously bullish, but we're on the brink of a potential energy crisis. If oil prices get up to 100, 105, 110, and they run with pure capitulation to 110, 115, 120, where it starts to not make any sense, again, energy stocks are going to keep running. They are flush with cash. Like, they're talking about heavy buybacks, they're talking about heavy dividends, and over the last decade, energy, like big energy, has been able to reduce their cost of doing business by a lot. We have companies in the US that can make profit on oil at $40 or lower. So the fact that oil's at $90 a barrel, it's like, that's operating with like Keystone markups. Crazy, right? So anyway, year to date, the proof is in the sectors. What's performing well? Consumer staples, again, not in the green, but it's like, what is the least amount of volatility? I'd take consumer staples all day. Consumer staples over discretionary all day. Discretionary is getting beat up badly. Staples is tight. Financials are fine. Energy's hot. Utilities, again, we don't have great premiums around these, but there's decent staples. We have earnings reports. That's fine. Financials are decent and safe, and rates are likely going up. And it's not just here in the U.S., but it's elsewhere. Bank of England's talking about raising rates. Bank of England potentially talking about raising rates. Other central banks talking about raising rates. So the great central bank race is coming off of zero for the first time since, 2018, I guess. So anyway, all right. So like I said, it's going to be a management week. Come back and join me on Friday for the Pulver Report. Let's see how we did this week. Lots of stocks and options, lots of expirations. It's going to be a crazy Forex week. Let's see how much volatility we have. Is it a wild week where at the end of it, nothing happens? It could be one of those weeks where there's so much volatility, this happens, and we finish on Friday and it's all nothing, right? Or this happens for the entire week, or this happens for the entire week. I want to be prepared for anything. So I'm trying not to get overly committed, overly married to any type of narrative or analysis. I will continue to trade and plan. Okay? All right, everybody. This week in the trading rooms, I'll see you. Equities on demand will start in 10 minutes. Tuesday, Wednesday, Thursday for Flex. Have a great week. Okay, see you back here on Friday. And again, appreciate the thumbs up and the likes and the channel support. And I'll try to get a couple videos out here in the next couple weeks for youtube.com/Chris Pulver. All right, thanks, everybody. Take care. Talk to you soon. Bye.